So that's part about the foreign buyer's tax. I want to talk about, say, now you bought it, now you want to sell it, now what are you going to do? Because if you're a foreigner and you buy it, you don't come here and live here, well, then you got to deal with selling it. So there's a whole bunch of other issues with withholding tax, which is the federal tax that they apply for non-residents who are selling their real estate. And then you have to look forward to that when that time comes. And now at some point you become permanent residents, you own it, then you don't have to worry about this. Okay, the next screen.
So non-resident, this applies to Canadians that are declared non-resident.
That applies too. Yeah. So for this one, it's not like the first foreign buyer's tax, which is, citizen, permanent residents, everybody else is a foreigner. This one they apply also if you're a non-resident and you're a citizen of Canada. So it also applies. You're a citizen, but you don't live here. Okay, then this tax becomes applicable. It does, yeah. So it's not just status in terms of immigration that also tax that. So, and then if you're non-resident and there's a test for that, some people say, hey, I pay my taxes, Canadian taxes, but I live in another country. In that situation, it's not necessarily it's maybe evidence showing that you intend to pay your Canadian taxes, but the CRA will look at all the evidence. It will look at what you have and what you own, your ties to Canada, have you been here, do you live here, do you have family here, to assess whether or not you really are a non-resident or not. So, and then what is this tax and how much is it paid? Well, 25% of the gain in terms of the value, and generally spoken, how much you paid for it, how much you're selling for, and the difference between the two. There are other things involved in terms of other items that an accountant is more specialized to deal with, and they give a final exact amount. But generally, 25% of investment property, and if the property is used as a business, like say, for example, a non-resident citizen or non-foreign owner, non-citizen, non-permanent residents, if they run a business in Canada, then it's 50% of that gain, not just 25%. So it could be quite high depending on the situation, okay?
So I have a question. This is on the gains, right?
That's
so
right.
Suppose the property did not gain or lost some money.
Yeah. So if it's proven at some point with all the documentation that there was nothing there, then there's nothing to pay. But
so there wouldn't be any 25. 25 is only withholding of the gains.
That's right.
That's what it says.
No
Okay.
gain. Then yeah. But the thing is, like, some people say that, hey, look, I have what I paid for. I have what I sold it for. There's no gain, except that as is. But it's really, there's little things about that accountants would know that somehow something make you applicable. Maybe you paid for something, maybe you got a benefit, maybe you rented it out during the time, you got income, maybe there's some things that it's better to get a tax advice to really be sure, an opinion as to whether or not there is any or not, because it's not as simple as just what you paid for and what you sold it for. That's the most obvious thing. That is some of the frameworks to use, but not the only things that are used. But it's good to get an approximate idea of what is how much you have to pay. So I just have a little tip about, when you 25% of the price. There's a procedure involved, which I don't think most of our audience would probably need to know the procedure part and what the lawyers have to do and what the realtors have to know. So I'll just go past it. You might want to know a little bit about the process in terms of, you also have to hire an accountant when you're selling a real estate when a foreigner non-resident citizen selling, they have to get an accountant to process a form that gets filed with the Revenue Canada to determine exactly how much. And then the Canadian government will issue a certificate of compliance, or called a clearance certificate. When everything that's supposed to be paid is paid, or if there's nothing to be paid, then we get that certificate. So anybody who's buying from a non-resident seller, then you should wait to get this to have a bill of clear sale, because CRA in Canada, I don't know about other countries, the CRA makes a lot of people responsible to collect the tax on behalf of the CRA. So if the seller was supposed to pay, the buyer didn't inquire and investigate and didn't protect and didn't make these things such as hold back monies, then the buyer can be on the hook for what the seller was supposed to pay.
Wow.
And it's the same thing for when we get to the next segment about the GST, which is a federal tax as well, that, the buyer is supposed to pay, but the seller is supposed to collect. If the seller failed to collect from the buyer and the buyer is gone, the seller has to pay, but even if they didn't collect it from the buyer, and then if the buyer is supposed to pay and the seller didn't collect, and then the buyer can still be chased after, even afterwards. So,
So in our residential sales contract now, there is a area to sign off whether you're resident or not. So this is something to pay attention to when a seller declares non-resident, then the buyer should be alert.
Yeah, exactly. Automatically right away.
Yeah.
And I've had a few people that they think that they're resident just because they pay their Canadian taxes, even though they live somewhere else, like Hong Kong or China. And that's not the case. Just because you live somewhere else and you pay your Canadian taxes doesn't mean that you're Canadian resident.
Right. So, you need the PR card.
You have to be where do you physically live and where do you live it? If there's any doubt, there could be a lot of how would you say, negotiation, investigation still, not just they declare it. But is that simple check mark enough of an investigation when you know something is wrong? Like, for example, the seller writes down, hey, I'm Canadian, but everybody knows they've been living for the last 5 years outside of Canada. How can they be Canadian, right?
But during the pandemic, is there any leeway as to how long you need to live? Because, traveling is very difficult.
Yeah. So that's the whole thing. Like, the proving and evidence to confirm that your principal residence is somewhere when it's physically really not. Then you have to have evidence and balance of probabilities that more likely than not that you never really intended to live somewhere and you're only there temporarily, but you got stuck because of whatever happened. One day I went on a cruise and hey, I couldn't come back. Well, that happens. So, so anyways, next thing is that, taxes, residency, CRA, there's a lot of murky issues and you need a good tax accountant to give you good opinions and a lawyer to protect your interests when that situation arises. Okay. Next, clearance certificate. I'm just going to go to a few more down the line. I want to go to GST now because we mentioned about how Canadian government gets people in Canada to be the tax collectors for CRA. So GST is one of them. GST is a 5% tax on any brand new properties or properties that have been rebuilt. So a property that used to be old, completely demolished, rebuilt, GST becomes re-applicable on that price of that property.
So what is the percentage that it needs to be rebuilt? I heard it doesn't have to be 100%.
Well, I wouldn't say percentage because they say that there's a few pieces of evidence that you can use to gauge whether or not, and one of those things is an occupancy permit. So if the house becomes such a state that it's no longer livable in, that is not safe to live in, that means that there's a home that's being renovated that does not have an occupancy permit issued after the construction. That means, that's one way of knowing that it's completely, how would you say, unlivable. So that's one evidence. It's not a percentage basis, like how much percentage down, but there's a bunch of pieces of evidence and documents which would support one versus the other. Now, the fact that it's right down to the foundation, that's a good sign. Yeah, but if you take the roof off, well, nobody can live in the house while you're living in it, then that can be used against the idea that this place was not fully renovated. But it's because you have the roof gone, nobody can live in the home. But is it substantially renovated? Well, the roof is such a substantial part of a property. And no roof, can you call that property something that's not substantially renovated, right? Anyways, but the idea is that if it's been rebuilt and from the foundation up, for sure it's going to be GST applicable.
Replacing a roof then is not GST applicable.
Well, what I'm saying is it can be.
Oh.
Yeah. The idea is that all the electrical systems are not finished. They've been in such a state that it can no longer be lived in. Well, that's a substantial renovation.
Well, so it can be GST applicable. Wow. Okay.
Yeah,
Good to know.
And then there's other ways in which if you had a residential home, properties used to be not, and then all of a sudden become, based on how the owner treats that property. I'll give you an example. So I had a client years ago that was buying 9 rows of houses, and there's tenants in each of them. And the seller was saying, hey, don't worry, they're all residential, therefore they shouldn't have any GST applicable. But what had happened was one of the contractors hired by the owner of the company, which the 9 units, claimed an input tax credit. They claimed the credit on their own GST account, which then, because in CRA's view, if you take even like $1.50 from a hammer from Home Depot and claim it to offset the GST that you outlay for this property, that means you consider this whole property a business. And if it's a business, then it's applicable, regardless if it's no longer residential anymore, because you claim it like a business. And you claim some tax credits, input tax credits, offset your own payment of GST. And it converts all 9 units because it's owned by the one same owner, even though it's owned, related to only one house. That the whole 9 units, the whole 9 houses become GST applicable. The buyer that was trying to buy, all of a sudden, hey, wait a minute, I didn't plan to pay 5% on top of the 9 houses that I'm paying for. It's very, very difficult, very tricky. But the CI rules are quite tricky.
I have another question. Recently, I have a client purchase a property, and she wanted to resell it immediately. Then, I read somewhere in one of her chats, Realtor chats, they said, GST could be applicable twice. If you didn't live in it and you sell it as brand new, the next buyer may also have to pay the GST.
Well, it's almost like you have to. It's not even a guess.
Oh, twice pay GST.
Exactly. Here's the CRA view. You buy a brand new property, GST is applicable. You're trying to say that I lived in the property as my principal residence and therefore I don't have to pay charge the GST and turn around. But if nobody's lived in it, it's like inventory. The seller is considered a business inventory, a business with inventory of property to sell. GST becomes applicable because it's never used as a residential home.
So when the second GST, I heard somewhere, the second GST is the gap of the 2 GST, right? So suppose she bought it for 500,000. Now it's at 700,000. So the difference of GST is 200,000 that you have to pay.
No, it's not.
Or 700.
Her price.
Wow.
Yeah.
700 on the total.
The total, yeah. Because let's just use the example, in BC, I don't know if Canada, nobody knows, but if you buy 6 donuts, it becomes GST applicable less than 6 or something like that. Anyway, let's just say you have a donut. You pay your tax on it, you get the donut. And you turn around and sell the same donut. It becomes applicable because you never ate the donut. You never used it.
I see. So you're better off renting it out, even at a lower market rent.
That's right. Yeah. Well, if you're the seller, you're not supposed to pay the GST anyways. But you have to think about it. Because when you sell it to a buyer, the buyer will say, hey, I have to pay GST on it. Well, then you think about, and I've seen a lot of contracts where they didn't think. They just put down GST is included in the price. And then it's a big chunk out of the price because that's 5% of your whatever you're thinking is your profit when you sell, taken out right out. Because if you include it, you have to pay it because you can't say it's not GST applicable. It is included. So you buy.
So the seller pays because it's included in the purchase price.
If they write it down on the contract. If it's GST is on top, well then the buyer pays it. The buyer knows that they're willing. Are they willing to? They know that it's 5% on the entire price, right? So
another question is: suppose I have a builder. They have a residential property. They, during the construction, let's say the construction was $1 million. So they pay GST on the construction about 50,000. Now they sell it, the end house, as $2 million. So sometimes the buyer will put the purchase price include GST. Now the builder, how much GST the builder pay at the end? Because they already pay the 5% on the construction.
Yeah. So when they sell it for $2 million, and if the GST is included, they take it off their $2 million that they're selling.
So they would pay on the remaining $1 million on GST.
No, it's just the price minus the back out of GST, whatever. It doesn't matter how much you put in. It doesn't matter how much was used by the builder to pay for the equipment or the cost of the contractors or the supplies. You pay GST all the way straight through. And then when you sell it, if you sell it with the contract clause saying the price includes GST, it's the GST on the total price.
So you don't get credit from collecting, you pay $1 million of GST in construction?
Well, in sense, as you build and as you pay and as you collect income, you do that anyways as a result. You do that. you offset what you collect from what you pay. But so that if the builder was to think about the price and they're going to market it as including GST, you better calculate that price, and so that it covers what you paid out. Like you built in the 5%. I want to clear 100,000. You better not start from the back that 100 is included in the 2 million before you back it out. You gotta.
So it's still like you just still need to, have the 5% aside.
That's right, or considered either on top, and then you don't want to. If you calculated your profit based on 2 million, then add GST on top. But if you calculated, say, hey, I want to profit from a net of 2 million, then you better sell it for 2 million plus 5% to take out the 5%. Because it's not yours, no matter where it's going to go. Yeah.
Right.
Yeah, and I think it's whose GST is it? It's the buyer's GST. It's not the seller's.
Yeah. Yeah. Well, so a lot of times buyers want sellers to include it.
Yeah.
It's a huge amount, or they should split it.
And it's huge, and the idea is that the buyer is supposed to pay. The seller is only supposed to collect. So really. Yes. This GST out of that 2 million it really is buyer's GST, not the seller's GST to offset, right? So.
Right, yes.
Yeah. It's a lot.
It's
if you're
a lot.
not thinking about it, you be at a loss. So you better get a good realtor to tell you, like Melissa. Better hire Melissa. She knows how to do it now. Okay. Anyways, we talked a little about GST, so, on top of a pre-sale home. Now, one thing I want to talk about is a lot of our listeners may have had a pre-sale, so it's not yet completed. And when thinking about all these extra taxes, maybe they want to assign it. They want to find a local person here to buy it from them, take it off their hands. And here we call that an assignment. You assign the rights to purchase this pre-sale home to someone here. There's a GST on the assignment price as well. So then now you're looking at it, there could be potentially.
So the GST is on the lift.
On the whole assignment, on the whole amount. Not
the whole amount. So the GST is on the whole entire assignment amount.
That's right.
Yeah.
And so there could be an assignment amount paid by the buyer of the assignment. And then later on, when the buyer of that assignment completes on the whole house, when it's finished completed, they pay GST on top of that. And then when the buyer comes to buy it from them after they've completed, then there's another GST, and they got to think about it, right? There's not just two instances in which GST becomes applicable at this point. There's three in a pre-sale, like if there was an assignment and then a purchase and then a sale. And then that's why my screen, GST on pre-sale, assignments, purchases, and resale. There's GST in everywhere.
Right. I understand what you mean, because it's never lived in. That's why the next has to pay.
That's right, yeah.
So that's why it's triple GST.
Yeah. Now the thing is that just like the foreign buyers tax, where you have a year after becoming permanent residents, you can apply for a refund. If the person bought a pre-sale, pays the GST on it, turns around and sell it before anything happens, and the buyer of that pre-sale pays GST, the seller can apply for a refund of the GST he paid on the purchase. So in that situation, they can apply for a refund. But that's only if there was a person who paid that. Now, be careful about this. Some buyers come in and says, I don't want to pay it. It's not applicable. And the seller doesn't think it's applicable. Nobody puts it on the contract. Everybody sells without making the inquiries, and then CRA finds out and says, hey, Mr. Seller, you're supposed to have collected it. Now we're going to ding you for it. It can't happen.
The seller may have the chance to get the rebate. Wouldn't the rebate just cancel the collection part out?
Only if the buyer actually
only if they qualify for the rebate, I guess.
Yeah. Well, if they qualify for rebate, and then the rebate, now for those who don't know, there are rebates for the GST available, so you don't have to pay the full GST, so long as either you live in the home within, I think the time frame is within 40 odd days of purchase, I think. You have to actually physically live in the home you buy in order for the rebate to be applicable, and it's like 36% of the GST. So, and also there's a minimum value for the home for that rebate to apply. I think it's a $450,000 home before you can apply for that. If it's more than that, you can't get a rebate. So there is a little help but you have to actually physically move in. So if you're a foreign buyer and you can't prove you moved in, then the GST office will come after. But anyway, so the thing that I was trying to say is that if nothing was done about the GST, the CRA can choose who they want to go after for that. Hey, Mr. Seller, you're supposed to collect, or hey, Mr. Buyer, you're supposed to pay. Whoever they can access and find let's just say the lowest hanging fruit. They can see who's easier to collect money after. The seller usually is the choice because they have a property, or the buyer buys it, supposed to pay. They have a property, but they can't really just pay money out of a property. But it's pressure and it's a lien. They can put a lien on it, right? Anyway. How does it apply? When does it apply? Yeah, lots of GST issues, and I just mentioned a lot of them. There's 2 occasions when you sell, assignment, you pay GST on that. You pay GST when you close the price. And my next little slide here is a GST rebate part that I just mentioned about. And so as long as the price of the place is below $450, those are still around. They're not that many, but you can find some places that are $450 that are brand new. Anyways, one more thing about GST is that the CRA considers the seller of a place that's never been lived in before as if they were a builder for GST purposes. They stand in place of the developer because they're selling to the public as if it were just the same as they bought it before they bought the pre-sale completed. Anyways, that's their terminology. That's how they rationalize it. Anyways, another tax. This is the tax, the Vancouver City Empty Home Tax and BC Speculation Tax, which is the tax that you pay while you own your home and before you sell it, and if you're not living in it, or if you're renting it too. Or, during that time frame, you either have to rent it, have someone live in it. And in those situations, if you don't have anybody living in it, nobody renting it, then you have to pay these taxes. Now, what is it and how much? And, well, of course, the Vancouver City Empty Homes Tax, only applicable in Vancouver, and the 3% of the market value of the home while you own your home. So they use the BCSS value to determine that taxes. They don't require appraisals to see how much the home is worth in the market. They take the assessment amount, 3% of that, and you get the bill you pay every year if you don't rent it. The speculation tax, we call it BCST, for non-residents, non-citizens and permanent residents or non-resident citizens, 2% of the value of the home, which is considerable. It's quite a lot. So you have, in Vancouver, you have potentially 2 particular taxes applicable. You have 3% of this and 2% of that. Of course, the 2% of the owner, there's the vacancy tax. I would just say here, who does it apply to? If you have a home, if any part of the home is not occupied for more than 6 months, so you can have a tenant in a house that's renting a room out of a whole entire 2-3-story building. That's still okay. It's lived in and it's not empty. Okay. On the speculation tax, it's a tax based on each owner's percentage, the percentage of the owner's home that they own, and that's taxed on that. So you can have a home with 3 owners, and one owner is non-resident, non-citizen, and the house is empty. So only the non-person, you have to use that calculation of the percentage to calculate the percentage of the tax owed. Let's just say that's how the assessment is done. So but you own the entirety of the home, you don't have to worry about that part.
Or rent it out.
Yeah. Rent it out, and rent it out. This is another thing too. The speculation tax, they have another thing, where they assess who's renting the house. If the person renting the house is not an arm's length person.
Yeah, non-arm's length, yes.
Yeah, they're their so-called rent, and they're living in $200 a month, and they're living in a mansion because they're paying rent. But they look further into that tenant. Who is this person? And if that person is part of a family, where the family is paying more taxes as a whole outside of Canada, then the tax becomes applicable. So it's more than just is it empty or not, but is it empty with someone? So, and if they find out that, hey, so this is like a situation where a student lives in a home, the parents live in China.
Yeah.
It's lived in, yes, but the kid doesn't make any income tax and doesn't pay any taxes in Canada. all the income is by the parents, they're living outside of Canada, then it becomes applicable.
Oh wow! So can maybe they rent it to a friend as well who pays rent, and then the kids can live in it?
Yeah. Well, then they look at something else. Sometimes they look at, does the rent collected
market rent? It's got to be market rent, right?
Yeah, exactly. So they look at the market rent, and I want to give you a little, I have a snapshot somewhere. A satellite family is what they use to refer to the people who most of their parents who own the home, or the spouse of the person who lives in the house lives outside and makes more money. They consider that a satellite family. If they're part of a satellite family and more money is outside, being earned outside. But they have another thing here I want to show you.
What about satellite family?
Yeah, here, look at the screen. Now, The tenant's income must be more than 3 times the annual fair market rent of the entire residential property in order for it to be not qualified to have to pay the tax. So think about this. Say the market rent for the year, like $2,000 a month, you pay rent. For the whole year, that makes $24,000. So that tenant's income must be more than 3 times that rental income. It must be more than $72,000 for that tenant's income in order for this to be applied.
So let's say for like a satellite family, the husband works abroad and then the wife is here with the kids. So maybe they have no status. So now the market rent, let's say is $5,000, right? Or let's say $5,000, just simple math. And then so she has to make how much money?
Let's say 12 times 5 is 12 times
30,000. Is it 30? No, 40.
Yeah. We're bringing the accountant here. Where is he? He has the automatic calculator.
60,000. 60,000 would be the annual rent. And so 60,000, so she has to report $180,000?
$180,000 of income.
Okay, so let's say, what if they set up like a company and she is kind of like consulting? Could that work? That she would just declare, like, pay taxes for $180,000.
So one of the things about those type of situations where they want to say report income so that they can avoid this tax is the CRA, they have this thing. Years ago, they allowed companies or privately owned companies to flow through dividends to their family to the income split. And then they changed the rules about 3 years ago, 4 or 5 years ago, where you have to prove that those people actually worked, and you have to have proof that they worked in order to earn the income. So you can give them, but then they have to say, well, you're only doing reception services and you're making $180,000 a year. They may not call that a legitimate pay rate for the kind of work they're doing for the company. You can try it, but they can probably evaluate it and audit it. Say, hey, your only job here to do is what? And how much you're being paid what? So.
It'd be like Canadian consultant.
Yeah. So anyways, they just like, and I...
Lifestyle consultant.
And while I used to do immigration, when I used to practice immigration, I didn't do this much anymore, but one of the things we had to show, if a person who's Canadian gets employed outside of Canada, and the time that they work can be considered as if they were in Canada. And so that you don't have to, like 2 years outside of Canada, you can apply for citizenship if you're in Canada, but if you're outside Canada working, well, only if you're working for a Canadian company, then you can. So a lot of them try to do that, and then they would evaluate what kind of work you're doing and whether or not it's really work. You're doing just for the citizenship, or you're really doing work. So. And then there's a lot of litigation in cases dealing with how they determine that. So yeah, if you want to go there, it's tricky. It can be done. It's just tricky, and then you got to have a lot of evidence and proof. And really, it's not that easy. Anyways, I just want to talk about that tax now.